Good morning. Let's definitely break down how you might approach calculating the minimum daily profit for your Nasdaq Crypto Index option and Dow Jones option bear put spread strategy during a bearish market movement in the US. First, let's make sure we're on the same page about what a bear put spread entails and how it generates profit in a bearish scenario. Understanding the bear put spread, a bear put spread is created by buying a higher strike price put option and simultaneously selling a lower strike price put option with the same expiration date. Buying the higher strike put? This is your protection against a significant downward move. You pay a premium for this put. Selling the lower strike put. This helps to offset the cost of the higher strike put you bought. You receive a premium for selling this put. Profit potential in a bearish market. This strategy profits when the price of the underlying asset, in your case the Nasdaq Crypto Index or the Dow Jones, declines. The maximum profit is capped and occurs if the price at expiration is at or below the lower strike price. Calculating the maximum profit. The maximum profit for a bear put spread is calculated as follows. Maximum profit, SUS, higher strike price, lower strike price. Net premium paid where? Higher strike price, the strike price of the put option you bought. Lower strike price, the strike price of the put option you sold. Net premium paid, the difference between the premium you paid for the higher strike put and the premium you received for the lower strike put. Calculating the minimum daily profit. The challenge, calculating the minimum daily profit for an option strategy like the bear put spread, is inherently complex and not straightforward. Here's why. Time decay, theta. Options lose value as they get closer to their expiration date. For put options, time decay generally works against you if the price doesn't move favorably. Volatility, vega. Changes in implied volatility can significantly impact option prices. In a bearish market, volatility often increases, which could initially benefit your put options, but this is not a guaranteed daily effect. Underlying asset price movement, delta. The sensitivity of the option price to changes in the underlying asset's price, delta, is not constant. It changes as the price moves and as time passes. Non-linear payoff. Option payoffs are not linear. A small daily decline in the underlying asset might result in a different profit/loss each day due to the factors mentioned above. A practical approach to estimating potential daily profit. Instead of trying to pinpoint an exact minimum daily profit, which is unrealistic, here's a more practical approach to understanding and estimating potential daily profit. 1. Scenario analysis. Define price targets. Determine realistic daily or weekly price decline scenarios for the Nasdaq Crypto Index and the Dow Jones based on your market analysis. Use an options calculator or simulator. Input the details of your bear put spread, strike prices, premiums paid/received, expiration date, into an options calculator or trading simulator. These tools allow you to model how the spread's value might change based on different underlying asset price movements and time decay. Simulate daily price changes. Run simulations where you input small, consistent daily price declines within your bearish outlook and observe the resulting change in the value of your bear put spread. 2. Focus on the overall profit range and break-even points. Calculate the break-even point. The break-even point for a bear put spread is break-even point equals higher strike price, net premium paid. If the price at expiration is below this point, the spread will be profitable. Understand the maximum loss. The maximum loss is limited to the net premium paid. This occurs if the price at expiration is at or above the higher strike price. 3. Monitor daily changes in option prices. If you have already established the bear put spread, closely monitor the daily price changes of the individual put options. This will give you a real-time sense of how the spread's value is fluctuating. Keep in mind that these daily changes are influenced by the factors mentioned earlier: time decay, volatility, and the underlying price movement. Example: illustrative, not real-time data. Let's say for the Nasdaq Crypto Index. You bought a put option with a strike price of $100 for a premium of $5. You sold a put option with a strike price of $95 for a premium of $2. Net premium paid $5, $2, $3. Maximum profit $100, $95, $3 to $2. Break-even point $100, $3.97. Maximum loss 3 hours. Now, if the Nasdaq Crypto Index falls, day 1, the index drops by $1. The value of your $100 put might increase slightly more than the decrease in value of your $95 put, due to delta. The net value of the spread would likely increase. Day 2, the index drops another $1. The increase in the spread's value might be different than day 1 due to changing deltas and time decay. Key takeaways. Predicting an exact minimum daily profit for an option strategy is not feasible due to the dynamic nature of option pricing. Focus on understanding the maximum profit potential, maximum loss, and break-even points of your bear-put spread. Use scenario analysis and options calculators to estimate how the spread's value might change under different bearish scenarios. Monitor the daily price movements of your options if the trade is already in place. By focusing on these aspects, you can gain a better understanding of the potential profitability of your bear-put spread strategy in a bearish market without trying to pinpoint an unrealistic minimum daily profit. Remember that options trading involves risk, and it's crucial to manage that risk effectively. Please like, subscribe, share, and comment.